Welcome to the Research Desk.
Glad to be here. We have a really incredible deep dive today.
We absolutely do. So I want to set the stage for you. Think back in 1999.
Oh, the dot-com era.
Right. Wall Street analysts were using these flawlessly constructed, beautiful spreadsheets to value internet companies. Companies with literally zero revenue.
Yeah, valuing them at billions of dollars.
Exactly. And then, fast forward to 2008, the smartest mathematical minds on the entire planet built quantitative models that were so precise and yet so fundamentally flawed that they nearly collapsed the global economy.
Which is terrifying when you think about it.
It really is. So today, we are opening up an amazing piece of source material. It's an excerpted analysis titled Valuation, Science or Art?
A classic debate.
Yeah. And our mission for this deep dive is completely clear. By the end of our time together, you are going to thoroughly understand the underlying mechanics of market valuation.
And more importantly, you're going to learn how to protect your portfolio.
Right, from two of the most dangerous forces out there, the arrogance of pure mathematics and the psychological traps of human narrative.
Because those two forces destroy more wealth than almost anything else.
Absolutely. So we're taking you straight to the core of how financial value is determined, how it's deconstructed, and let's be honest, occasionally completely fabricated.
Completely fabricated. Yeah, the central tension driving this deep dive is honestly the most enduring debate in finance.
Right.
Constructured, mathematically rigorous models, and I'm talking specifically about the discounted cash flow model, the DCF, can they actually tame our subjective biases?
Or do human narratives, like the stories and the emotions, just ultimately dominate the market?
Exactly, and you face this choice every single time you allocate capital. Are you trusting the cold, deterministic calculus of a spreadsheet? Or are you relying on intuitive, narrative-driven judgment, kind of like Warren Buffett does?
It really is the ultimate showdown. It's like the left brain versus the right brain of Wall Street.
It is.
But before we draw the battle lines, we have to establish some common ground. The source material makes it very clear that no matter where you fall on this spectrum of science versus art, every financial expert actually agrees on a few foundational truths.
Right. The first being that valuation is inherently, inescapably forward-looking.
Always. You're constantly relying on uncertain growth projections. You're estimating discount rates for a future you can't possibly know.
Yeah, and you're calculating terminal values for businesses literally decades down the line. No model is perfectly objective. That's just a fact.
Right.
The math itself might be flawless. 2 + 2 is 4. But the numbers you feed into that math, those are born from human judgment.
And human judgment is flawed.
Deeply flawed. The analysis highlights that behavioral biases systematically distort valuations. Things like anchoring, herding, the narrative fallacy.
We'll definitely get into those later.
Yeah, they twist the numbers in ways that are so insidious and often completely invisible to the actual person building the model.
Okay, let's unpack this. Because if everyone agrees that the inputs going into the model are essentially just educated guesses, why do we treat the output as gospel?
It's a great question.
Why does Wall Street worship a spreadsheet when the whole foundation is built on subjective assumptions?
Well, this brings us directly into the bull case. The argument for the science of structure. You need to understand why discipline and data act as actual necessary guardrails against our bias.
Right. So let's deep dive into the objective mechanics.
So frameworks like the DCF, comparable multiples, regression analysis, they aren't just calculators, they are structural boundaries. They actively constrain bias by forcing you to anchor your expectations in observable macroeconomic data.
Give me an example of that in practice.
Let's take growth projections. Without a structural model, a biased analyst could look at a trendy company and just arbitrarily declare, oh, it's going to grow at 15% forever.
Which happens all the time in pitch decks.
Exactly. But the model forces discipline. The source material gives a very specific, undeniable illustration of this. Imagine you have a company with a 2% historical growth rate.
Okay.
And it operates in a mature industry. Now, you combine that historical data with a projected macroeconomic GDP growth rate of 2.5%.
Right, the broader economy.
Yes. When you blend those, you create an objective, data-backed basis for a 3% growth forecast for that company.
So you're building a realistic ceiling.
Precisely. You are logically and mathematically prevented from just pulling a speculative 15% projection out of thin air. You're tethering the company's future to the actual gravitational pull of the economy.
Because a mature company simply cannot outgrow the GDP of its host economy forever.
No, it can't.
I mean, eventually it would just swallow the entire economy. It's a basic mathematical gravity. If a company grows at 15% while the economy only grows at 2% in a few decades, that one single company would be the entire GDP of the planet.
Exactly, which is impossible. And this brings us to one of the most debated components of any valuation, the terminal value.
Right, the terminal value, which for anyone listening who isn't living in Excel every day, often accounts for 60, 70, or even 80% of a company's total calculated worth in a DCF model.
It's a massive chunk of the valuation. It represents the value of the business into perpetuity long after your specific 5 or 10-year forecast period ends.
And skeptics always argue the terminal value is just a massive, wild guess.
But it isn't, not if you use the science. The Gordon growth model completely refutes that argument. It is the ultimate defense against guesswork
How so?
because it ties the terminal value directly to long-term macroeconomic data, specifically inflation and GDP growth. It's grounded in extensive data, not intuition. Let's look at the actual math structure.
Please do.
The formula calculates the final year's free cash flow, assumes a constant growth rate, and then divides that by the discount rate minus that growth rate.
So the denominator is discount rate minus growth.
Right. And here is the critical structural guardrail. The math completely breaks down. It yields a negative or an infinite value if your growth rate exceeds your discount rate.
Oh, wow. So you literally can't plug in a crazy growth number.
You can't. The Gordon growth model mathematically forces you to choose a realistic terminal growth rate, one that usually hovers right around long-term inflation or GDP growth.
So you are physically anchored to reality by the equation itself.
Exactly. And let's dig into that discount rate for a second. That's the mechanism you use to bring future cash flows back to today's present value.
Right, specifically the weighted average cost of capital, the WACC.
Yes, the WACC. It's built on the cost of equity and the cost of debt. Now, the cost of debt is not some subjective feeling you have about a company's risk.
No, it's very real.
It's anchored to the bond market. The source material is explicit here. A company with a Bear 2 credit rating objectively commands a higher cost of debt than a company with an Echo rating.
Because the rating agencies have already quantified the default risk.
Right. The bond market operates on tight spreads and massive liquidity. When Moody's assigns a Bay 2 rating, they've analyzed interest coverage ratios, debt to EBITDA, tangible assets. They've mathematically defined the risk.
And then the DCF model just imports that objective reality.
Exactly. By enforcing a higher WACC on a riskier company, the model mathematically punishes that risk. It drives down the present value of those future cash flows. It's a totally emotionless mechanism.
It stops an overly enthusiastic analyst from overpaying for a risky asset. That's the beauty of the structure. It takes a vague, scary concept like risk and translates it into a punitive percentage point.
And the science goes even further with sensitivity analysis. This is the math of scenarios.
Yeah, testing the structural integrity.
Right. You run the math across multiple scenarios to see how fragile your assumptions actually are. The text gives a perfect example of this mechanical objectivity.
Walk us through it.
Say you calculate a base enterprise value, or EV, of $100 million, but then you tweak the WACC and the growth rate just a tiny bit.
Just to see what happens.
Exactly. Say you drop the WACC by 50 basis points and raise the growth rate by 0.5%. Suddenly, your optimistic scenario swings up to $155 million.
That's a huge jump.
It is. Conversely, if interest rates rise, so your WACC increases and growth slows, your pessimistic scenario plummets to $68 million.
So you're seeing exactly how sensitive your final number is
Yeah.
to the absolute slightest change in inputs.
Right. It quantifies the boundaries of possibility. It forces you to look at that $68 million downside and ask, do I have the risk tolerance to absorb that reality?
Okay, I hear you. I understand the mechanics, but I have to push back here.
Go for it.
Sensitivity analysis makes your subjectivity transparent, sure, but it certainly does not eliminate it.
Well,
I mean, you're still the one deciding what constitutes the optimistic and pessimistic inputs, right?
yeah.
You're deciding the optimistic growth rate is 3% and not 4%. You aren't discovering objective truth.
You're defining boundaries.
You're just mathematically defining the boundaries of your own personal bias. You've built a really precise, really beautiful box around your own guesswork.
And that pushback brings us directly to the Bear case, the art of judgment.
Let's get into it.
The Bear case argues that the mathematical precision of the DCF is a total illusion. It's a dangerous facade of certainty that just masks the absolute dominance of human psychology.
Because outputs are only ever as reliable as the assumptions fed into them. And those assumptions are fragile.
profoundly fragile. Think about it. You build this complex DCF, you calculate the WACC to the exact basis point, you project 10 years of free cash flows.
Meticulously adjusting for working capital and capex.
Right. But at the end of the day, you are trying to predict technological shifts, market share capture, and consumer behavior a full decade into the future. That is pure speculation.
What happens when a new competitor drops a cheaper, faster product in year 3? Or consumer tastes just pivot overnight?
The model breaks. And it breaks not because your math was wrong, but because the environment changed. Geopolitical events or sudden shifts in trade policy, they can destroy a historical growth trajectory instantly.
Yeah, tariff goes up,
Yeah.
your margins are gone.
Exactly. They violently alter the discount rate overnight. If international supply chains are severed, your historical 2% growth rate is completely obsolete. Raw materials spike, margins compress, free cash flow vanishes.
And the perceived risk skyrockets. So the WACC spikes, and your enterprise value just collapses.
The math cannot protect you from systemic reality.
Here's where it gets really interesting. The vulnerability isn't just external macroeconomic shocks, it's internal psychological distortion.
Oh, absolutely.
The psychology of valuation is where the whole concept of objective science just completely unravels. The source material outlines 3 massive behavioral biases that basically hijack the modeling process.
Let's start with anchoring. It's the human tendency to cling to arbitrary initial numbers.
How does that actually look in a spreadsheet?
It's fascinating. Say a stock is currently trading at $200 a share in the open market. An analyst builds a DCF to find its intrinsic value. Subconsciously, their brain is pulled toward that $200 anchor.
Even if they think they're being objective.
Right. So they run the model and it spits out $120. Immediately, they feel cognitive dissonance. They assume, oh, I must have made a mistake in my math.
Rather than assuming the market's just wildly overvaluing the asset.
Exactly. So what do? They go back into the spreadsheet. They lower the discount rate by a fraction of a percent. They bump the terminal growth up by 20 basis points. They massage the margins.
Tweaking it until the output magically hits $195.
Yes. They reverse engineer the math to justify the current price. They aren't discovering value, they're justifying the anchor. That is false precision infecting the process.
And then you compound anchoring with herding. Because analysts don't work in a vacuum, right? They're in a highly competitive, reputation-driven ecosystem.
Herding is massive. It's the phenomenon where analysts converge their estimates to match the consensus. Because there is massive career risk in being the only analyst projecting a steep decline for a beloved company.
Nobody wants to be the one guy saying sell when everyone else says buy.
Let's say 90% of Wall Street has a buy rating on a major tech stock. If you publish a sell rating and the stock goes up, you lose your job.
Right.
But if you publish a buy rating with everyone else and the stock crashes, you keep your job. You are wrong with the herd. It is far safer for your career to be wrong with the crowd than wrong alone.
So the models are subtly manipulated to conform to consensus, which completely destroys any claim to independent, objective science.
Totally. And then we hit the narrative fallacy. Humans are storytelling animals. We crave a sexy, compelling story over dry facts.
If a company has a charismatic founder promising to save the world with disruptive tech,
Analysts will completely ignore dreadful financials. They will build models that justify the story, rather than models that reflect economic reality.
and history is full of mandatory case studies for this. The dot-com bubble is the perfect example.
The quintessential example. The narrative of a new economy powered by the internet completely overwrote fundamental valuation principles.
People were literally throwing out price-to-earnings ratios.
They discarded them as relics of the industrial age. Analysts invented absurd new metrics, price to eyeballs, price to clicks.
Just to justify astronomical valuations for companies that had never generated a single dollar of profit.
The narrative dictated the math. And then we look at the 2008 financial crisis. This was the ultimate failure of quantitative arrogance.
Because they had the smartest math guys in the room.
The absolute smartest. They built incredibly complex models to value mortgage-backed securities, MBS, and collateralized debt obligations. They used tools like the Gaussian copula function to measure default correlation across thousands of mortgages.
But their overconfidence in those models masked devastating systemic risks.
The models assumed housing prices on a national level would never drop simultaneously, because historically, over the data sets they fed into the machine, they hadn't.
So the math inside the models was Perfectly executed. The equations were sound.
Yes, but the foundational structural assumption that national housing markets are uncorrelated was fatally flawed. When the narrative broke and housing fell nationwide, the models were completely worthless.
We don't even need to look back decades, though. Think about meme stocks. GameStop.
Oh, GameStop. A perfect modern example of narrative obliterating fundamentals.
Retail enthusiasm and social media narratives propelled that stock to the moon. The price completely detached from the reality of a struggling brick-and-mortar video game retailer.
If you tried to value GameStop using a traditional DCF based on its actual cash flows during that squeeze, your model would have output a single-digit share price. It would have screamed at you to short the stock.
And if you trusted the math and shorted it, the narrative-driven market would have absolutely bankrupted you.
Because the squeeze was a function of market mechanics and narrative momentum, completely divorced from discounted cash flows.
So, to really grasp this tension between rigid math and chaotic reality, we need to look at how the source material uses analogies.
Analogies are crucial here for bridging theory and reality.
Exactly. Let's start with film direction. I love this one. Think of the DCF model as a film script.
Okay.
The script gives you precise dialogue, scene descriptions, structure. It's very exact. But if you hand that identical script to two different directors, you get two wildly different movies.
Because the director's subjective vision shapes the final impact. Pacing, lighting, casting.
Right. In finance, the DCF is the script, but the analysts are the directors. You give identical historical revenue and margins to a bullish analyst and a bearish analyst, and their subjective assumptions about the future produce wildly different valuations.
It perfectly highlights the human element operating the machinery. Another powerful analogy from the text is ecological resilience theory, comparing markets to ecosystems.
How does that work?
An ecosystem is highly dynamic, nonlinear, unpredictable. A tiny change in a predator population or a slight temperature shift cascades through the environment in ways no scientist can perfectly forecast.
And markets operate the exact same way. Millions of participants constantly reacting to each other.
But valuation models are fixed and linear. They project cash flows in straight lines over 10 years. They assume steady growth. A linear model fundamentally struggles to capture the non-linear shocks of a real market ecosystem.
Which reminds me of another cinematic analogy, film noir.
Oh, right.
In a true film noir, the protagonist is basically doomed from the start. No matter what they do, the tragic outcome is baked into the universe. The source material suggests subjectivity and valuation is like that.
It's inescapable.
Exactly.
Yeah.
Subjectivity isn't just background noise you can filter out with a better spreadsheet. It is the fundamental gravitational force. Your bias dooms your objective model the exact second you open Excel.
Which brings us to a final, very practical analogy. The chef.
Let's hear it.
Treating human bias as a mere variable you can adjust for is misguided. It's like a chef believing they can predict the exact taste of a dish merely by measuring the raw ingredients.
Measuring the flour and butter with perfect precision.
Right, and assuming the outcome is guaranteed. That completely ignores the volatile heat of the stove, the humidity in the kitchen, or the current mood of the diner eating the food. Valuation is as much about the human judgment applying the heat as it is about the numbers.
So what does this all mean? What are the smartest people in the room still getting wrong? We know the math is rigid. We know humans are biased. Where is the hidden trapdoor here?
The wild card. The blind spot most analysts miss is structural model risk.
Structural model risk. Break that down.
You have to make a vital distinction between uncertainty and error,
Right.
or input risk versus model misspecification. Everything we've discussed so far, anchoring, bad growth projections, narrative fallacy, that is input risk.
Meaning you're using the right tool but feeding it bad data.
Exactly. Model misspecification is an error in the core architecture of your thinking, using the wrong equation entirely.
So a clean DCF with bad assumptions gives you a bad valuation. But applying a DCF to a fundamentally unstable business is financially fatal.
Fatal. A DCF mathematically assumes relatively stable, predictable, positive cash flows over time. It assumes the company is a going concern.
But what if you're looking at, say, an early-stage biotech firm? Zero revenue, burning massive cash, and its whole existence hinges on one FDA drug approval.
If you apply a standard DCF to that biotech firm, you are fundamentally misapplying the tool. The company will either cure disease and generate $50 billion or fail trials and go bankrupt.
So the payoffs are strictly binary.
They are options. A DCF cannot model a binary option. It'll just try to average those extreme outcomes into a single, completely meaningless present value.
It's exactly like using a thermometer to measure distance.
That's a great way to put it.
You can calibrate the thermometer perfectly, read the mercury down to the millimeter, but it will never tell you how far away you are. Analysts fail because they force non-stationary businesses into stationary tools just because it's the only tool they know.
To a man with a hammer, every problem looks like a nail, which is why we have to synthesize these opposing forces. We have to reconcile the rigid art of the spreadsheet with the chaotic science of behavior into a practical philosophy.
So how do we define that synthesis?
Valuation is neither pure science nor pure art. It is best defined as disciplined inference under uncertainty.
Disciplined inference. I like that phrasing.
The science is the structure, the strict accounting consistency. Revenue must flow logically to operating income. You have to account for cost of goods sold. Operating income flows to free cash flow after taxes and capex. The balance sheet must balance.
So the structure enforces financial physics. You can't project doubling revenue without modeling the massive capex required to build the factories to support it.
Exactly. And the art is selecting the assumptions that populate that structure. It's interpreting the competitive landscape, judging if an economic moat is widening or narrowing, and crucially, knowing when your model is overconfident.
Let's go back to that sensitivity analysis example. Base EV of 100 million, swinging to 155 million, or crashing to 68 million based on tiny WACC tweaks.
It proves that models process subjectivity. They do not eliminate it. You feed your subjective feelings into the machine, and it processes them with perfect mathematical consistency to show you the logical conclusion of your own bias.
False precision happens because the spreadsheet is deterministic. You hit enter, it gives you exactly $123.45.
It feels like a law of nature, but the future is non-deterministic. Reality only offers a spectrum of probabilities.
Which is why the highest quality investors don't worship numbers. They manage ranges. They combine model discipline with deep narrative skepticism. Because valuation doesn't discover value floating in the ether. Valuation constructs value.
It builds a logical framework you use to justify risk and capital, and this directly informs how you must operate in the market.
Right. Let's get to the most important part. What this means for your portfolio. How do you actually deploy capital armed with this knowledge?
The source material provides authoritative, direct, actionable allocation rules, and you must implement these to protect yourself. Rule number 1, allocate exactly 10% to cash reserves. No hedging on this.
10% to cash. Why exactly 10?
It gives you the specific optionality needed to capitalize on inevitable valuation discrepancies caused by subjective analyst biases. When herding drives a sound asset into the ground because of a negative narrative, that 10% lets you buy it at a steep discount to its structured value.
Right, you can't buy the dip if you're fully deployed.
Yep.
Rule number 2 targets value specifically.
Deploy exactly 3% into value ETFs, specifically VTV and IWD.
The Vanguard and iShares value funds.
Yes. But this is highly conditional. You only execute this when the market-implied equity risk premium, the ERP, exceeds its 10-year average by exactly 1 standard deviation.
Let's quickly explain the mechanics of that trigger for the listener.
Yeah.
The ERP is the extra yield you demand to hold equities over risk-free government bonds.
Correct. If a 10-year treasury yields 4% and expected market return is 9%, the ERP is 5%. When that ERP spikes 1 standard deviation above its decade average, it's a mathematical signal that the market is gripped by fear.
Investors are demanding an unusually high premium for equity risk.
Exactly. Historically, peak fear means value-oriented, cash-producing equities are systemically undervalued. The math tells you the narrative is too pessimistic. That's when you deploy the 3% into VTV and IWD.
Got it. Rule number 3 focuses on quality and pricing.
You must overweight companies meeting 2 strict criteria. First, a return on invested capital, or ROIC, consistently above 15%.
Because ROIC proves they have a sustainable moat and allocate capital well.
Yes. But you can't overpay. So the second criterion is an enterprise value to EBITDA ratio strictly below 10 times.
EV to EBITDA under 10.
Combining ROIC over 15% with EV to EBITDA under 10 forces you into stable, mature industries. These are businesses where a DCF model is actually structurally appropriate and you're buying at a reasonable multiple.
Okay, rule number 4 is about playing active defense.
Short sectors entirely reliant on optimistic long-term growth projections. Early-stage unprofitable tech is the prime example. You must reduce your overall exposure to these speculative sectors by precisely 10% over the next 12 months.
Because in a DCF for unprofitable tech, 90% of the value is terminal value,
Yeah.
decades away, creating massive duration risk.
A slight rise in interest rates violently crushes those valuations. You reduce exposure by 10% to protect against mathematical gravity.
Rule number 5 gives us room to play the narrative game, but safely.
Allocate exactly 7% to narrative-driven stocks, but strictly focus on companies with strong, data-backed narratives, meaning real revenue growth and tangible user metrics that are currently undervalued due to negative market sentiment.
You're buying the underlying math while waiting for the herd to return to the positive story.
Exactly, exploiting the gap between sentiment and financial reality. Rule number 6 is your hedge against those unpredictable ecosystem shocks.
The black swans.
Maintain a strict 15% allocation in uncorrelated assets, specifically gold. This is your structural defense against geopolitical instability or trade wars that break linear equity models.
Because when a shock hits, correlations go to 1. Everything drops. Gold stabilizes you.
Exactly. And the final rule, Rule 7, addresses a model misspecification directly. Reduce exposure to speculative biotech by exactly 10%.
Back to the thermometer measuring distance.
Right. Speculative biotech relies entirely on binary option-like payoffs. Traditional valuation models are structurally misspecified here. You can't rely on a DCF for an FDA trial. Reduce by exactly 10%.
So here's the bottom line. We've traveled from the rigid math of the Gordon growth model to the psychological chaos of GameStop meme stocks. Valuation gives you a rigorous scientific framework. It forces you to tie your terminal value to macroeconomic reality.
But it never gives you a certain outcome. You have to treat outputs as ranges with confidence bands. Ultimately, valuation is less about measuring reality and far more about exposing the story you are secretly telling yourself about the future. The job of the valuation model isn't to tell you the answer, it's to reveal which assumptions must be true for the answer to hold.
I want to leave you with a final thought. Look at the biggest holding in your portfolio right now. Are you holding it because the mathematical structure of its cash flows and ROIC are truly bulletproof? Or because the market's current narrative just makes you feel safe? What happens to your model when the ecosystem shifts tomorrow? This is the research desk officially signing off.